Welcome to the Explainer. Today, we're cracking open a really fascinating anonymous expert report to completely deconstruct one of the most powerful, yet honestly, profoundly misunderstood mechanisms in the entire US tax code. We're going to establish a deep analytical focus here. We want to dissect the strict mechanical and financial benefits of the real estate professional status, or as it's commonly known, REPS. We're looking exclusively at the cause and effect relationships that make this specific status an absolute game changer for advanced capital preservation.
So here's our logical roadmap for today. We'll be looking at 1. The passive loss limitation, 2. Mechanics of professional status, 3. The depreciation multiplier effect, 4. Strategic spousal labor division, and finally, 5. Accelerating net wealth velocity.
All right, let's jump right into Section 1, the passive loss limitation, the systemic bottleneck.
To really understand the solution, we first have to surgically isolate the fundamental problem that's restricting high-income earners. Right, so following the 1986 Tax Reform Act, the government instituted these passive loss limitations. And according to the deep financial analysis in the report, this limitation acts as the absolute core barrier for most investors. It dictates this incredibly rigid rule. Passive losses, like the massive paper depreciation generated by rental properties, can typically only be used to offset passive income. You've really got to understand the implicit assumption the IRS made here. Basically, they wanted to curb tax shelters for high-earning professionals who were, just parking their money in real estate without actually running the properties. So they explicitly trapped these paper losses inside a specific, totally isolated category on the tax return.
Just look at this firewall the IRS built. It's like a giant wall. On one side, you have your passive income, rental cash flow, dividends, things like that. And on the other side, you've got your active income, your W-2 wages, 1099 contractor earnings, or high-yield business profits. The system strictly, and I mean strictly, prevents passive rental losses from crossing over to touch those active W-2 or 1099 tax brackets. So if you're a highly compensated engineer, a specialized surgeon, or maybe a tech entrepreneur, your primary income is classified as active. But if your rental property takes a massive paper loss, well, that loss is stamped as passive. Because of this systemic bottleneck, the two pools of money absolutely cannot mix. No way. Your real estate losses are trapped, entirely unable to reduce the heavy tax liabilities generated from your primary job.
Moving right along to Section 2, Mechanics of Professional Status, the Exemption Mechanism. And here is where the real estate professional status, or REPS, enters the chat. Now, to be clear, this isn't just some casual title you throw on your LinkedIn profile or brag about at a dinner party. It is a rigid, highly specific regulatory designation. But when it's successfully achieved, the effect is profound. It's immediate. It legally reclassifies your rental real estate activities from passive to non-passive, meaning active. This is the exact structural exemption mechanism that literally tears down that IRS firewall we just talked about. By changing the classification of the loss, it unlocks your ability to take those real estate paper losses and apply them against literally any form of income you produce. It effectively converts those trapped losses into incredibly powerful active tax shields. But as you might guess, the IRS doesn't just hand this exemption out lightly. Not at all. The very first strict compliance threshold requires that an individual must spend a minimum of 750 hours per year actively working in real property trades or businesses. To put that into perspective, that breaks down to roughly 14.5 hours every single week dedicated relentlessly and specifically to real estate operations. And we're not talking about passive reading or listening to an explainer here. This is documented, active operational time. For the average investor who's already balancing a really demanding career, finding 14.5 hours a week is a monumental hurdle for sure. Furthermore, the analysis indicates there's a second, honestly even more restrictive hurdle. More than half, yes, 50%, of all personal services performed during the tax year must be dedicated to real estate.
Let's unpack the implicit assumption here. Think about it. If you work a standard W-2 job for, say, 2,000 hours a year, you would theoretically need to work 2,001 documented hours in real estate just to pass this 50% test. It's wild. It's a mathematical barrier designed specifically to test what your true primary occupation actually is. This effectively, and very intentionally, bars almost all full-time W-2 employees from qualifying for this status directly on their own. And it doesn't stop there. Beyond just logging the raw hours, one actually has to satisfy material participation tests to rigorously prove their active involvement. This is exactly where we see the cause and effect of operational control versus mere capital deployment. The IRS wants to reward true operators, not just people parking their wealth. So to qualify, you've got to either dedicate more than 500 hours to the specific rental activity, be the sole substantial participant doing nearly all the operational work, or actively make the key day-to-day management decisions. You absolutely cannot just be a silent capital partner hoping for a quick tax break. You literally must be the hands-on operator. Let's dive into Section 3, the depreciation multiplier effect, weaponizing paper losses. So, how does REPS mathematically transform a high earner's tax return? I want you to think about that for a second. Why does it actually matter if we can offset active income if our rental properties are only generating a tiny incremental paper loss each year? Well, the truth is, the status alone just isn't enough. To truly weaponize this mechanism, we need a cause and effect method to generate a massive paper loss immediately. And the mechanical solution for that is cost segregation combined with bonus depreciation. Normally, the IRS makes you depreciate a residential building super slowly, just grinding it out over 27.5 years. But a cost segregation study surgically breaks a property down into its granular individual components. It isolates short-lived property items. We're talking things like specialty flooring, appliances, custom cabinetry, landscaping, stuff that carries 5 to 15-year lifespans. Then, by utilizing bonus depreciation, the tax code actually allows investors to deduct the entire cost of those specific components in the very first year. Now, why would the government allow this? Simple. It's an implicit incentive system. They're actively encouraging property improvement and rapid capital investment. For the investor, this means you generate massive artificial paper losses on day one without actually losing any cash out of your pocket. It's brilliant. Notice the massive difference here. By pulling decades of standard straight-line deductions into a single year, you create a targeted, absolutely massive tax shield exactly when your active income might be at its highest peak. Instead of taking a tiny, negligible deduction every year for almost 3 decades, you force a paper loss of potentially hundreds of thousands of dollars immediately. And the most beautiful part of this cause and effect relationship? This all happens even while the physical property itself might be simultaneously appreciating in real market value. It's like having your cake and eating it too. Let's actually deconstruct the math of this cause and effect relationship to see exactly how it plays out in the real world. Imagine a taxpayer earning $200,000 in active W-2 wages who also forced a $150,000 paper loss on a newly acquired rental property using cost segregation. Without REPS, that $150,000 loss is completely trapped behind that passive loss limitation firewall we discussed. Their taxable income remains fixed at $200K, but with REPS achieved, that exact same $150,000 loss is reclassified as non-passive. It directly attacks and offsets the W-2 income. The taxable income is instantly reduced by 75%, dropping straight down to just $50,000. That is a total game changer. All right, moving to Section 4, Strategic Spousal Labor Division, the workaround. But remember that systemic bottleneck we discussed earlier? Full-time high earners mathematically cannot meet the 750-hour and 50% tests if they are working a demanding corporate job. Well, here is a highly actionable insight from the report. The tax code contains an implicit assumption regarding joint filing rules that offers a pretty brilliant strategic workaround. Under joint filing rules, married couples do not both need to be real estate professionals. Only one spouse needs to qualify for REPS to completely unlock non-passive losses for the entire household's combined income. The step-by-step strategic division allows the household to operate with the ruthless efficiency of a corporate balance sheet. Think of it as specialized household labor optimization. Spouse A focuses entirely on maximizing high-yield active earnings in their specialized career or business. Meanwhile, Spouse B treats real estate as their primary profession. They can easily fulfill the 750-hour and material participation requirements because they aren't fighting a full-time W-2 schedule. When they combine forces on a joint tax return, Spouse B systematically shelters the exact high-bracket income that Spouse A is generating. It completely removes emotion from the equation and replaces it with pure, optimized financial strategy. Talk about a power couple, right? And the deep analysis shows this strategy scales far beyond just single-family rentals. For those who actually achieve this status, even massive paper losses from complex, large-scale apartment syndications can be unlocked. Now here is an absolutely crucial, non-obvious detail. Normally, if you invest as a limited partner, an LP, in a 200-unit apartment complex, the massive bonus depreciation passed down to you is strictly passive. But if the material participation requirements are strategically met, which often requires you to transition into a general partner or GP role to prove real operational involvement, those massive institutional-level paper losses can legally flow through to completely offset your active personal income.
And finally, let's look at Section 5, Accelerating Net Wealth Velocity, Capital Preservation. So, we really have to analyze the systemic conclusion of these mechanisms on long-term wealth generation. The underlying pattern here is all about velocity. Tax minimization is directly proportional to wealth velocity. When you use REPs and accelerated depreciation to legally wipe out a $50,000 or $100,000 tax bill, you have to factor in the time value of money. Those diverted dollars are immediately injected back into your own compounding cycle rather than leaving your ecosystem. That shielded capital becomes the immediate down payment for your next cash flowing asset, exponentially accelerating your asset acquisition over a standard, heavily taxed timeline. The power of compounding interest on shielded capital is just staggering over a 10 or 20-year horizon.
Ultimately, understanding these advanced mechanisms shifts a high earner from a reactive taxpayer, someone who merely waits to see what they owe the government every April, into a proactive, strategic architect of wealth. The analytical evidence makes it abundantly clear. The tax code is not just a set of punitive rules. It is a behavioral incentive system specifically designed to reward those who provide housing and deploy capital. So if the code is explicitly rewarding you to invest and operate this way, what highly incentivized action will you take next?